Before we start this video, do like and subscribe to our channel and not miss on any updates.
Okay, so now we'll move to the next standard, a pretty simple standard to be frank. Okay, but I've seen students not being able to answer the questions from this standard or not being able to write down the keywords. Okay, very simple standard. If a question comes, it should be like, okay, 5 out of 5 marks is in my pocket or 4 out of 4 marks is in my pocket. That simple standard is this one, but please ensure don't neglect this standard. Don't neglect the keywords of this particular standard. All right. So the next one that you're going to do is accounting standard 1. Now, as far as accounting standard 1 is concerned, accounting standard 1 talks about the first one it talks about is the fundamental accounting assumption. This all of us know. We have been learning from our foundation days, going concern, consistency and accrual. Going concern, consistency and accrual, or if you can't remember GCA, remember CAG. Okay, CAG. Consistency, going concern, consistency, accrual. Okay, these are the 3 fundamental accounting assumptions. If these 3 accounting assumptions are followed, we don't need any separate disclosure. But if this is not followed, disclosure is required in the financial statement. What does that mean? Say, for example, the enterprise is no longer a going concern. Means we don't expect that the enterprise will continue for the foreseeable future. Okay. If that fact is disclosed and the financial statements are prepared according to the information that going concern is no longer valid, it is prepared on something called as liquidation basis, then no need to worry because the financial statements disclose, they have already disclosed that going concern is no longer applicable. All right. So what is going concern? And here, please note down the keyword that you need to remember and write in the examination. The financial statements are prepared on the assumption that an enterprise will continue its operation. This is the first one. It will continue its operation in the foreseeable future. In the foreseeable future, that is the first part. And neither there is an intention nor there is a need. No intention, no need to materially curtail the scale of operation. So this definition, you have to learn it by heart. Okay, then only you'll get marks. So assumption that it will continue its operation in the foreseeable future and has neither any intention nor there is any need to materially curtail the scale of operation. Means they will continue foreseeable future. More than 1 year you can consider that the enterprise will continue to run its operation. Financial statements are prepared on going concern basis, and when we prepare financial statements on going concern basis, what we are trying to represent is we have assets at the value for which we will get future economic benefits. That is one thing. Second important thing is we have profit to replace the assets consumed in operation and for settling the liability. Basically, we are saying that we have money, we have sufficient pooled of resources. With that money, we can run the business, we can run the operations, and we can purchase assets in the future as well. That is the first assumption, which is the going concern assumption. The second one is consistency. Consistency means we are using the same accounting policies for similar transactions in all accounting periods. Same transaction, same accounting policy. Same transaction, same accounting policy. Or same nature of transaction, same accounting policy. Does that mean we cannot change the accounting policies? We are not saying that. We can change accounting policies if it is required by a statute or law, if it is required by an accounting standard, or for more appropriate presentation of financial statement. These 3 points you need to learn by heart. Required by statute, required by accounting standard, and if it results in better presentation of the financial statement. So first one, going concern, will continue for foreseeable future. We don't have the intention nor there is a need to materially curtail the operations. That's the first one. Consistency, we have followed same accounting policies for similar transactions on year-to-year basis. Can we change? Yes, we can change. We can change provided there are 3 conditions which are satisfied in one of these 3 cases. Required by the law, required by accounting standard, or for better presentation of financial statement. Okay. Then third one is accrual basis of accounting. Now this is also required under the Companies Act that the transactions are recognized as soon as they occur, whether or not cash or cash equivalent is actually received or paid. So basically, Income is recognized when earned, and expenses are recognized when incurred, irrespective of whether cash has been received or cash has been paid. Irrespective of whether cash has been received or cash has been paid, income and expenses are recognized. Okay, so this also results in matching between revenue and expenses and profit and loss. Okay, that is the first part of the standard, talking about three fundamental accounting assumptions. Then accounting policies. Accounting policies are specific accounting principles and method of applying those principles adopted by the enterprise in preparation and presentation of financial statement. Accounting policies are what? These are specific accounting principles and method of applying these principles adopted by the enterprise in preparation and presentation of financial statement. For example, simple case, inventory. Accounting policy could be you use the FIFO method, you use the weighted average method. That could be one accounting policy choice. Then if you talk about foreign exchange, there could be a accounting policy choice as to which rate will we use to measure the transaction, or whether we will capitalize. If you refer to paragraph 46A, whether we will capitalize, we have already discussed this, or whether we will expense the exchange losses. That is a part of accounting policy. Okay, how will we recognize sale transaction? That is an accounting policy. So all of these are called as accounting policies. Now, whenever we have to choose accounting policy, standard sets out that some specific principles needs to be followed. For example, prudence. Prudence means you have to be careful. When we say prudence, you have to be careful. That is, you should not anticipate income. You should not anticipate income in advance, and you should make provisions for all anticipated expenses. So, if there are uncertainty associated with future events, profits are not anticipated, but losses are provided as a matter of conservatism. This is called the concept or principle of prudence. So, accounting policy should be, adhering to the principle of prudence. Accounting policy should be adhering to the principle of prudence. You should not have accounting policies where you are, maybe accounting for some specific items which are, let us say, you are anticipating gain in advance, or if you are doing, if let us say it is, the pencil went off, just allow me a minute. Okay, so first principle is prudence, which you need to remember. Prudence means we will not anticipate profits, but we will provide for all anticipated losses. So if there is a provision to be created, you will create the provision. But this does not mean you will create unnecessary provisions and expenses. That is also not allowed. Okay, just in the name of prudence. That is the first thing. Second, substance over form. Now, the best example of substance over form is what we have understood already in accounting standard 19 when it comes to finance leases. So the accounting policy should reflect the substance of the transaction rather than the legal form of the transaction. Now, when we learned accounting standard 19, we said in case of finance leases, we will recognize an asset. Now, when you say legal form, in legal form, there is no sale. In a finance lease also, there is no sale. But in substance and the underlying essence of the transaction, what the transaction actually mean, in that case, we say that, okay, the substance of the transaction represents that there is a sale that has happened. So accordingly, we will recognize a sale. Then materiality. Now, as far as the third principle is concerned, financial statement should disclose all material items. All material items. What are material items? Material items are those items which can impact the decision making of the stakeholders. It is not just about the size. If something is to do with, let us say, payment or transactions with related parties, then almost all the transactions become material. If it is something to do with, let us say, non-compliance of some laws and regulations, that can be material. So we should disclose the items which are material in the financial statements. So our accounting policies also should be based on similar parameters. And then lastly, all significant accounting policies should be disclosed while preparing the financial statement. Why? Because the user should know how have we prepared the financial statement, and hence it should be disclosed. All the accounting policies should be disclosed. The consideration in selection of a policy, prudence, then your substance over form, After substance over form, you will talk about materiality, and then we will talk about the manner of disclosures. Now, this is another important part of the standard, which talks about disclosure of changes in accounting policies. Accounting policy can be changed, and whenever there is a change in accounting policy, if it is material change in the current period, if the amount is determined, you will disclose the amount. If amount is not determined, you will disclose the fact that amount cannot be determined. So if there is a change in accounting policy which has a material impact in the current period, you will disclose. You will disclose the amount of change and impact of the change in accounting policy. Sir, we cannot determine the amount. Then you will disclose the fact that amount cannot be determined. Then if there is a change which is not material in the current period, but it could be material in the later periods, or it could you'll be able to ascertain the materiality in the later periods, then you will disclose the fact of change in later period. So whatever is the change impact in the later period, you will disclose in the current period. So any accounting policy changes, the impact that it will have in the current period as well as in the future period, you will have to. Then, if there is a deviation from the fundamental accounting assumption of going concern, consistency, and accrual, if there is a deviation, means if you have not followed, then you will have to give specific disclosures. The fact that you have not followed the accounting policy, that has to be disclosed. All right. Now, in the examination, you may get question mostly related to change in accounting policy. Now, whenever you get a question related to change in accounting policy, what you should do is you should define what is the accounting policy. Then what is the disclosure requirement whenever there is a change in the accounting policy. So what we should say, if there is any change in accounting policy which has a material effect, it has to be disclosed in the financial statement. Okay, it has to be disclosed in the financial statement. The impact of change also has to be disclosed. So you will disclose change and what is the impact of change in accounting policy, that has to be disclosed. So let's look at this. In the books of Prashant Limited, closing inventory amounts to 1,63,000 on basis of FIFO method. The company decides to change FIFO method to weighted average method for ascertaining the cost of inventory from year 1 to. On the basis of weighted average method, closing inventory as on 31st March amounts to 1,47,000. Realizable value inventory as on 31st March amounts to 195. Discuss the disclosure requirement of change in accounting policy as per accounting standard 1. Okay. Now here, this question has specifically asked about disclosure of change in accounting policy. Okay. They may also ask you, can they change? Because fundamental principle, consistency. Are we being consistent? No. So can we change the accounting policy? 3 reasons: statute, law, and better presentation of financial statement. That we have to write. But here it is about disclosure requirement. So what should disclose? Whenever there is a change in accounting policy which has a material effect, should be disclosed in the financial statement. Whenever there is a material effect because of the change in accounting policy, the fact has to be disclosed. Okay, that's the first thing. Then the amount should also be disclosed to the extent ascertainable. The amount of impact, whatever impact the change will have, that should also be disclosed. If the amount is not ascertainable, then the fact should be disclosed. So the Prashant Limited should disclose the change in valuation method of inventory and its effect on financial statement. Sample disclosure. Company values its inventory at lower of cost and NRV. This is as per accounting standard 2. Since NRV of all items of inventory in the current year was greater than respective cost, the company valued the inventory at cost. In the present year, the company has changed to weighted average method, which better reflects the consumption pattern as compared to the earlier practice of FIFO. The change in policy has reduced the current profit and value of inventory by 16,000. This is the impact. How do I calculate the impact? See, closing inventory as per FIFO would have been 163. I have done it at 147. I have reduced the value of inventory. If I reduce the value of inventory, my inventory will be lower, my profit will be lower. Okay. Then Jagannath Limited had made a rights issue in 2002. In the offer document to its member, it had projected a surplus of 40 crores during the accounting year ending 31st of March of year 2. The draft result for the year prepared on hitherto means so far, followed accounting policy and presented for perusal of the board of directors showed a deficit of 10 crores. The board, in consultation with the managing director, decided the following: value year-end inventory at work cost instead of method of valuation at prime cost. 50 crores instead of 30 crores. That will increase the valuation. Provide for permanent diminution in the value of investment which had taken place over the last 5 years, the amount of provision being 10 crores. As chief accountant of the company, you are asked by the managing director to draft the notes to account for inclusion in the annual report. Now, you may say, sir, is this the right thing to do? See, you can change the method of valuation of inventory. There is no problem. Okay. The only thing that the standard requires is you're changing the inventory from 30 crores to 50 crores. That additional 20 crores should be disclosed in the financial statement. If you disclose it in the financial statement, it is the user's headache. The users will understand, yes, this has been the change. Earlier, they used to do something else. Now they are doing something else because of which the profit has been impacted. Okay. So again, same standard answer. Any change in accounting policy which has material effect in the current period or expected to have material effect in the later period should be disclosed. If it has material effect in the current period, amount by which any item in the financial statement is affected by such change should also be disclosed. So that is a broad answer. Amount not ascertainable, even if you don't write, it is okay. Notes. During their inventory has been valued at factory cost against the practice of valuing it at prime cost, as was the practice till last year. This has been done to take cognizance of the more capital intensive method of production on account of heavy capital expenditure during the year. Sir, where will we get this information from? Even if you don't write this information, it is okay, right? As a result of this change, the year-end inventory has been valued at 50 crores and the profit for the year has increased by 20 crores. Now, the second one is not a change in accounting policy. It is an estimate that we are making. So that has to be separately disclosed, saying that we have provided for 10 crores as permanent diminution. This is an item of exceptional feature. That is why we have disclosed it separately. Clear? Right. Now, sir, how do we remember? No need to remember everything. Just write the principles and give your conclusion. XYZ company is engaged in the business of financial services. It is undergoing tight liquidity position since most of the assets are blocked in various claims petition in a court. They have accepted intercorporate deposits and making best effort to settle the dues. There were claims at varied rate of interest from lenders from the due date of ICDs to the date of repayment. So what has happened? There is an issue date. There is a maturity date or a due date. On the due date, you have not yet paid. So the lenders are asking that till the date of payment, you have to pay us interest. The company has provided interest as per the terms of contract till the due date, and a note for non-provision of interest on the due date to date of repayment was effected in the financial statement. On account of uncertainties existing regarding the determination of the amount and in the absence of any specific legal obligation, the company considered that these claims are in the nature of claims against company not acknowledged as debt, and the same has been disclosed by way of notes to accounts instead of making a provision. Now here, please understand, even if the contract doesn't have any requirement, after the maturity is done, you have to repay the loan. If the loan is not repaid, the interest will continue. Okay, so what you need to understand is, if interest will continue even after the due date, because the lenders will not leave you. Okay, you cannot say that as per the terms of contract, there is no interest after the due date. Then, as per the terms of contract, you are also required to pay the loan by the due date. If you have not paid the loan by the due date, the other party will definitely ask interest. So whatever is the amount which is on the overdue interest, that also needs to be provided for as a matter of, you can say, prudence and also accrual concept. Okay, you can draft the answer accordingly. Slightly complicated way that they have written there, but the essence should be captured in the examination. ABC was making provision for non-moving inventories based on issues for the last 12 months up to December 31st March of year 1. Company wants to provide during the year ended 31st March year 2 based on technical evaluation. Now, so far you are doing based on what? Slow moving, non-moving. Non-moving means inventories which is not being sold. That is what is called non-moving inventory. We were making provision based on non-moving inventory. Okay. Now, we want to change the method of making that provision to technical evaluation. Now, is it a change in accounting policy? Please understand. We were earlier also providing, now also we are providing. Just that measurement has changed. So when the measurement has changed, it is not considered to be a change in accounting policy. It is more about change in accounting estimate. So whenever there is a change in accounting estimate, which is material, if at all it is material, it has to be disclosed separately. This is also an important question from examination point of view. Okay. So AS1, though we, a lot of time it happens that, we consider it to be a simple accounting standard. As I told you, we miss out. Now with this, we have completed almost all the standards. I think we are left with accounting standard 24. Accounting standard 24 is one that we are left with. Then, yes, I think we are left with only accounting standard 24. Then buyback of securities, that is what is left. And the introductory part, which we'll try to cover it as quickly as possible. Okay. So tomorrow we'll cover, ACE 24 and the introductory part. Then we'll complete buyback of securities on 2nd. Okay. And on 2nd as well as on 3rd, we'll discuss how to handle case studies and MCQs in the examination. All right. I have been preparing solely from our study material. Is it sufficient? Yes, it is sufficient. Just do one thing. Practice some questions from the compiler that we already have provided. Okay, that will be more than sufficient. So Vijay, when is your attempt?
Sir, Jan.
When is your attempt, Vijay?
Sir, Jan, sir.
Yeah. So what you do is, we have provided compiler also. It is there in the resources section. Take some questions from compiler past papers and solve them. That will help you to handle the questions in the examination. Not to worry. Okay.
Sure.
Yeah. Okay. Thank you. Thank you, everyone.